We often talk about ESG investing, but the strategy could come with a cost. Christina Partsenevelos joins us now with the story of what you might call greenflation, among other things to think about. Christina, I hope we are.
Well, I'm going to get to those numbers to see if we are or not, but Americans get roughly about 80% of their energy from fossil fuels, such as coal, petroleum, and natural gas. And with so many itching to travel right now, demand for oil is expected to keep rising in the years ahead. But analysts at JP Morgan say right now as much as $600 billion must be invested in oil by 2030 to keep up with demand. But you've got banks, firms like BlackRock, funds like the Harvard Endowment Fund, who promise not to do as much traditional energy investing as they once did, preferring to focus on renewable energy sources that aren't as damaging to the environment. But a focus on ESG, environmental, social, and governance, is driving a credit crunch for oil and gas companies. And some argue that transition isn't cheap.
The problem with ESG is it's promising cake with no calories. All the good stuff with no sacrifice. And let's face it, being good will cost you.
With clean energy initiatives and supply chain issues, prices have soared for green energy raw materials like aluminum and uranium, helping the stock prices of aluminum producers like Alcoa and Uranium Energy Corporation. You can see on your screen, both up well over 100% this year so far. But coal-related job losses loom in energy-producing states like North Dakota and Wyoming, for example. And you can see this bar chart on your screen, just how many coal mines actually remain in the United States over the past decade. But many argue the short-term losses will be offset by increases in carbon-low sectors like solar and the electric grid. Listen in.
I think it's important to note that those increased investments in infrastructure will be outweighed by decreases in costs of energy. So the overall system-wide cost of electricity should be balanced out.
Companies that fall behind the green technology curve or stick to dirty sectors could see their access to capital markets turned off. But ESG advocates say the short-term costs, as we just heard, are just a feature of going green.